Welcome to our lecture this evening by John Reed. John Reed is the chairman of the MIT Corporation. From 1984 to 1998, he was the chairman of Citicorp, and after its merger with Travelers, he became chairman of Citigroup until 2000. I imagine at the time he retired in 2000, Mr. Reed expected he had done his chairmaning services. But in 2003, he was asked to step in to help resolve a crisis at the New York Stock Exchange, served as its chairman until 2005. It's noted he did that for $1 a year. It's not noted whether that was an increase or a decrease in his salary, but we'll assume. He's a graduate of MIT and Washington and Jefferson College. He's served in the Army. He served in Akron for the Goodyear. And he has served in the service of the public good as a member of the board for the BSO. He is a Bronze Beaver, which from its title you might not understand to be MIT Alumni Association's highest honor. And he has served in many other commercial boards, including Criteria Kaisha. Now, the thrust of Mr. Reed's work across the organizations he has served has been, whether intended or not, crisis resolution, and it's therefore no surprise that he has been asked by many to help us think through the financial crisis that this nation has just suffered, and more specifically to help us understand the rules that should be applied to financial institutions to assure that such a catastrophe does not repeat itself. And so in addressing those questions, Mr. Reed has become a disinterested expert, an expert because his experience taught him what he needs to know, but he has moved on from that experience and therefore is free and independent of it. And in this way, he is, of course, very much like the lecture we had from Mr. Volcker. Mr. Reed has been a strong defender of the independence that Mr. Volcker has been trying to engineer back into the financial system. But we are grateful that he has agreed to come out of his retirement once again to chair this conversation about the distinction between shareholder values and values from his perspective, as he modestly puts it, of a business person. But I'm not as constrained as he by his modesty, so I'll say a successful and respected business person who continues to give, however slow the world might be to accept. Thank you very much, Mr. Reed, for joining us tonight.
Thank you very much, and it's a mixed pleasure to be here. It's fun because I had to think about an aspect of what's going on in the world that I hadn't necessarily focused on. But on the other hand, when you're sitting calmly at MIT fussing around and you get a letter that says, we would like you to come and join us and talk about institutional corruption, and you are exactly the right person to talk about that subject, you scratch your head and you say, I wonder what's going on here. But in fact, I was asked if I could talk a little bit about institutional corruption, and it was interesting for me to try to think about it. I did go and ask, what does Mr. Webster think corruption is? And at least the old book that sits around the chairman's office at MIT, and I assure you it's got to be 25 years old, speaks about the impairment of integrity, virtue, or moral principle. And that is what I will take as my sort of thought as to what corruption might be. It's not criminal behavior. It's behavior that we might think doesn't reflect integrity, virtue, or moral principle. And interestingly, there's another comment not intended for the purpose that I'm thinking about that talks about the inducement by means of improper considerations to commit a violation of duty. Now, I'm sure they're talking about bribes, but I think you could argue when you think about what's going on in the financial sector that there may have been some inducements by means of improper consideration to, in fact, commit a violation of duty. Duty of care, some things of this sort. But in any event, when asked to think about this topic, I did go to the dictionary and I did sort of shape my thoughts about what's going on. You could get a lot of sociologists who would tell you much better than I can how bad behaviors can spread within organizations and societies. I'm sure it's a much studied subject, and I'm sure that sociologists have some theories and probably some pretty good facts as to how these kind of behaviors can spread. So I'm not going to be able to talk to you in any theoretical sense. I'm going to be able to basically share with you some experience and tell you what it is that I observed and what I think it means in terms of the financial industry, speaking mainly about the financial industry that is very much centered in New York. I think it would be a mistake to believe that the behaviors that are normal there are spread to every little bank in the country, because I don't think they are. But nonetheless, let me talk about it. As was pointed out in the introduction, you know, I joined Citibank in 1965, just out of MIT Sloan School. I was a trainee when I joined. At the time, the industry was a very traditional industry. It was almost a utility. Compensation was low compared to compensation in industrial companies. There was a certain prestige about it. Mothers liked saying their son was a banker, and people sort of self-selected to go into that business, who generally were extroverts, quite often coming from good educations and nice families, et cetera, et cetera. It was a world at the time where customer was first. It was very customer-oriented. People knew their customers. They tended to know them quite well. And a substantial portion of the business was spent trying to be very close to your customers. Banks don't do anything. They help others do things. If you want to buy a house, we have a product called a mortgage that facilitates buying that house, but you don't really want a mortgage, you want to buy a house. And it's true also of companies. They don't want loans. They may need to finance their inventory, and we have this product called a loan, but what they're looking for is a way of financing their inventory. So we're facilitators, and we help, be they corporate customers or individual customers, accomplish their goals. And that's why you have this customer focus. And one of the problems in banking is that the spreads in the business are very small, and yet if you have a loss, you lose 100% of the money. And so you can't afford to take many risks, because the upside is extremely small compared to the downside. We used to think that you could earn maybe 0.75% on a customer loan, but if it went bad, you lost 100% of that loan. And so by definition, the institutions became quite conservative, and they did not provide venture capital or equity financing or any of the things that are risky, simply because that was not the business of banking when I joined it. It's strange when you think of it today, but you know, the banks had a long history. We never were wildly profitable. We never were wildly unprofitable. We did go through crises from time to time. And if you looked at the financial system, you'll find that you have more first-generation capital than most industries do, and retained earnings tend to be a small portion of the capital structure, and that's simply because over long periods of time, banks don't tend to earn as much as industrial companies do, and hence retained earnings as a component of the capital structure tends to be quite small. All of which speaks to this industry that I joined back in '65, which was very much of a utility sort. And this was true also of the Wall Street houses. At the time, there was a clear separation between investment banking, trading houses, and brokerage firms. But the entire industry was very much customer focused. I could remember the chairman of Morgan Stanley approaching me once to try to help him with a problem, because he had sold some securities for a company that was not doing well, and he was very concerned that the people who had acquired the securities that he had underwritten would think poorly of Morgan Stanley since the company wasn't doing well, and he very much wanted to help the company so that his customers wouldn't suffer and he would feel better about his reputation. This is not a practice that you would find today. But at the time, this was very much it. Now, you should also think, and if we had the chief financial officer of Harvard University here, he could tell us that, you know, from the 60s into the mid-80s, the return in the markets were not very good. The stock market was pretty stable, it was pretty flat, and the result was that people who have large pools of capital were quite unhappy, because these large pools of capital were either endowments for great universities or hospitals or what have you, or they were reserves for pension funds and things of that sort. And the problem was, since they weren't earning a lot of money, the people were finding that they had to constantly add more money in order to meet their obligations. And so there was quite a bit of pressure on the investment community from the owners of capital saying, you guys aren't performing well, we're very unhappy, we pay you to get performance, you're not getting it, so forth and so on. That was a very important conversation, and I participated in some of those. I was on the board of companies that complained to investors about the return on pension funds. And we at Citibank were worried about the return on our own pension funds. And so that conversation was very much a factor in the sort of changes that I'm going to talk to you about tonight. And what happened is that some smart people in Wall Street said, you know what? We could get better performance if we take a position in a company and then we scare the management into doing well. And that was called greenmail. Now, there's probably less than half of you in this audience that are old enough to have heard the term. But back in the sort of late 80s, you started hearing this idea of greenmail. And what it was is it was investors who saw a company whose performance was particularly sluggish, and they would buy 5 or 6% of the stock, then they'd go to the management and they'd say, if you guys don't improve your performance, I'm going to go to your next stockholder meeting and we're going to have a proxy fight, et cetera, et cetera. And this developed some momentum, and it got institutionalized in the form of private capital firms of the sort that Mr. Romney was criticized for having been part of, people who would actually go and buy companies and then improve their performance as owners and then sell them back out into the market and make a lot of money. All of these activities were designed to provide investors with better alternatives that would be profitable for them and which would cause the investment returns to improve. Along the way, and this is where I talk about inducements, somebody came up with the idea that they should say to management, you know what, we don't care what you pay yourself as long as stockholders do well. And this mantra of shareholder value came into existence. And this would be mid-90s, I would say. And all of a sudden, and it continues to this day, you could not pick up an annual report from a company that didn't start out with the chairman or the CEO promising the stockholders that the only thing he, and I'd say he because most were he's, would think of from the time he got up in the morning till the time he went to bed at night was how to improve shareholder value. And it became and is still today one of the central values now, quite different from the bank I joined in 1965, where we didn't know what our return on capital was. We didn't have a budget when I joined in 1965. Earnings were what was left after you did all these good things with customers, and it wasn't, you didn't manage towards earnings. And in fact, when Walt Wriston, my predecessor at the bank, came out with a budget that targeted earnings for the year, he got a call from the head of the Fed saying that he thought it was improper for banks to target earnings. And this speaks to the culture that existed at the time. And he actually got that call. I can remember Walt coming into one of our management meetings and reporting it. And he had been chastised, if you will, for being so improper as to have a targeted earnings that the company would seek to achieve. So this revolution that started with Greenmail became pervasive, and it took hold, and companies to this day will start out, and I'm sure the business school across the river teaches its students, that the primary obligation and duty of management is to improve shareholder value. And this has, of course, had repercussions because it got into the compensation schemes quite deeply. And I'll tell you a little story which is absolutely true. My bank went through some problems in the early 90s. As we were coming out of them, I felt that there were a number of people, sort of about 100 by number, who had played a particularly important role. And I went to the compensation committee of the board, and I suggested that we pay them $40 million to be distributed amongst these folks. And we talked about it, and you could tell that the compensation committee was quite uncomfortable with the idea that we would pay out. Now, this is 1993, maybe, a sum as large as this. And I never pushed my board, and so I said, look, you guys are clearly uncomfortable with this, let's drop it. But I also had an obligation to try to pay my people properly. One of the jobs of a manager is to make sure that his people are appropriately paid. And so I fussed around, and it turned out that we had 7 million shares of stock that were eligible for stock options that we didn't need for other reasons. And so I went back to the board and I said, look, what would you say if we took these 7 million shares of stock? At the time, the stock of the company was selling for $30. And I said, we'll give it to the 100 people, we'll distribute it in the form of options. There'll be 5-year drop-dead options, and they vest only if the price of the stock hits $60. So the price of the stock would have to double in order for these to vest. If it didn't double within 5 years, they would disappear. And so this was clearly tied to shareholder value, because if the price of the stock doubles for those 100 people, it also doubled for the various millions of shares that were outstanding, and so the shareholder value would have been much enhanced, and one would presumably not complain because we paid the people. And so we did that. And fortunately, it paid out, and everybody made a lot of money. They made a lot more than we had thought. But the interesting question is this. I had thought that $40 million was an appropriate number to accomplish the goal. We just agreed to a formula that was going to pay out $210 million. But it was shareholder friendly, while the first was not necessarily shareholder friendly. And I had a very good board. You know, I had the chairman of Boeing and of Exxon and General Motors and DuPont, and these were all people running big companies. And yet at that time in 1993, the value system had reached the point where they felt that it was a better business decision to pay out $210 million in a way that was very shareholder friendly, because we had to accomplish something that was very valuable to the shareholder, rather than $40 million. And that has always stuck in my mind as a measure of the degree to which shareholder value had taken hold of our thinking and allowed a very intelligent, capable set of directors to make a decision. And as it turned out, the stock went to about 90, so we ended up paying whatever it was, but $300 or $400 million to get something done that could have been accomplished, I think, equally well for 40. Needless to say, those who received these benefits came to think that that was a very nice thing that had happened to them. I got a piece of it. And I probably wouldn't be chairman of MIT today if I hadn't, because they now have it. And but the point is that is a quite interesting measure of the degree to which values of shareholder value had gotten inculcated into the industry. The second thing that happened, and I think there are two key things in this story, is some of you all in the academic world came up with a lot of very sophisticated and fancy mathematics of finance. And, you know, a wave of people were graduated from various business schools and began to populate the financial industry. And, you know, in order to have a trade, you just need to have two people who see things in compatible ways. It doesn't have to be right or wrong, but they each have to see the world in similar ways. And so you populate the financial community with a bunch of people who have been educated in basically probabilities of strange things happening, and they can buy and sell these probabilities. And that's what started happening in the trading side of the business. And you found, and I saw this happen, it happened while I was there, that markets will disintermediate institutions. And so what happened, and it started with mortgages, somebody, I think it was in Lehman, but I'm not sure, came up with the idea that instead of having banks keeping mortgages on their balance sheets, why don't you package a bunch of them, and you could sell that package of mortgages to an investor, and that will provide the investor with a better return than other alternatives then available. Remember, the whole story of modern finance has very little to do with allocating capital or people who borrow money. It has everything to do with investors and the need that investors have for products that will give them a better yield than what had existed before. And so somebody came up with the idea of packaging mortgages and selling them to the market. There was a big market for them. You know, we had packaged movies for years. You can't lend money to a Hollywood producer to make a single film because no one has a clue whether that film will make money or not. In fact, most don't. But for years, Hollywood had been financed by packaging, you know, 20 films, and one of the films probably would do well and it would pay off the loans for the other 19. And so the idea of packaging things so as to handle the statistical distribution of losses and so forth was not new, but the idea of developing a market where portfolio managers could begin to shape their portfolios by buying financial instruments that had just the qualities that they might be seeking to balance out their portfolio, that was new. But it began to develop, and it's first developed in the form of let's just have mortgage pass-throughs. But then people started doing what is called slicing and dicing, in the sense that somebody said, hey, I'd like the principal payments from year 5 to 9. This other person would like the interest payments from year 12 to 14. And this is slicing and dicing these mortgage-backed securities. And, you know, if you are trying to construct a portfolio, you might find that the interest payments are worth a certain amount to you, but of course you have to know the probability that there will be such payments at that period of time. And so you really have to become quite a mathematical gymnast to engage in all of these things. But the industry grew up, and the demand came out of the investors. This could not have happened in the developing world. This can only happen in a world that has big pools of investing capital. And it has to be a world in which you have large bodies of capital that are invested by professionals who are trying to make money on financial investments. These are not industrial investments. You're not building a new factory. These are simply financial investments. And if you're the chief financial officer at Harvard, you care very much how the endowment does, and you're looking for opportunities to invest in financial products that provide whatever level of potential return or potential risk you're willing to live with. So this built up. Now, if you have the combination of shareholder value and take your blinders away with regard to compensation, as long as it appeared to be parallel to shareholder value, and then you have all of a sudden the disintermediation of institutions that used to make financial loans, keep the liabilities on their own balance sheet, and all of a sudden these liabilities are taken out of your balance sheet and sold into the market. Pretty soon you have the ingredients for a very fundamental change in the industry. And that change will be one where instead of being customer-centric, which it used to be, they'll start packaging financial products, and you become salesmen to sell those financial products to people who are going to sell the products to investors. And so the entire balance of activity started shifting towards people who could sell products to investors. They knew that, the California pension fund was interested in assets that had a certain quality. They'd go back and say, hey, can't you guys manufacture some assets that have that quality? Because I have a guy who would like to buy some. And of course, you can, if you slice and dice, take financial items like a mortgage or anything else, and you can create mathematically something that appears to have the attributes you want. And of course, the investor always wanted to have some kind of protection, so they said, we want these to be rated. And of course, so you go to the rating agencies, and in the beginning, if you had a bond issue or something, you went to a rating agency and they'd look at you and they'd rate that bond based on their feeling as to, your credit worthiness. But these products became very complex. And so what started happening is people would go to a rating agency and say, hey, I need a AAA for this product. Now, what do I have to add to the mix so that you guys are going to be happy to have a AAA here? And the rating agency, it'd say, well, if you'd add a little more equity here, or you'd put a little of that there, well, then we think this package looks like a AAA. And so it became a sort of joint venture as to how you manufacture things that had the ratings. And of course, the rating agencies are paid for doing the ratings, and they're paid by the originator of the liability, not the purchaser of the asset. And so economically, it became, all of the inducements were running the wrong direction. And all of this came from this idea that, you were in business to create shareholder value. Shareholder value is, your earnings and so forth and so on. If you could earn more money, you were doing the right kind of thing. You didn't worry all that much about customers, and humans being human, pretty soon they said, well, this package of mortgages isn't quite right, but who cares? We're going to sell it anyway, and we don't care who buys it. And the originator doesn't care. If you have a mortgage loan with a financial institution and it happens to be sold, you're unaware of it. You have the house that you wanted to buy, and you're quite unaware of the fact that your particular product is part of a big package and so forth and so on. So the combination of shareholder value, which was accompanied with this idea that, hey, if you align compensation with shareholder value, then there is no other determinant of compensation. In the old days, they sort of said you were paid about as much as it takes to get this job done, and if you won't do it, we'll hire the guy behind you and he'll do it for that wage, and therefore that's the wage you'll get. All of a sudden, the question became, what have you contributed to the shareholders? And of course, some of these activities had the appearance of creating a lot of value for the shareholder. There was a big difference between realized earnings and book earnings because everything was marked to market. And there was a period of time when a lot of products appeared to have been very profitable, but when it came time to sell them, you didn't ever realize those profits on which you had paid the bonuses and so forth. So you had accounting problems as well as everything else. But the industry fundamentally shifted to the point where it became out of control. And the meltdown in '08, it happened to be '08, it happened to involve a bunch of mortgage-backed securities, but it was going to come because of the behavioral sort of structure that had crept in. We had given up worrying about the customer. We began to be product creators and product salesmen, and we were rewarded handsomely for creating and selling products. And of course, the volume of products that you could create and sell greatly exceeds the number of customers that you would normally have on the asset side of the business. And in fact, most of the major banks were buying products from mortgage brokers and others because they couldn't create enough product within their own institution. You know, I talked to Jamie, who runs the Morgan Bank, Jamie Dimon, once, and he said the losses on mortgages that they had bought from mortgage brokers was substantially higher than the losses on mortgages that had been originated within their branch system. But all of the banks, and by the way, Chase was less involved than most because it didn't have a Wall Street presence at the time that this started going on. Remember, they're an amalgam of Bank One, which was out in Columbus, Ohio, and then the First National Bank in Chicago, and they didn't have a Wall Street presence, so they were late to the party and therefore less damaged than others. But even they had been buying these mortgages, so it was the combination of shareholder value becoming this great thing, the idea that compensation, as long as it seems somewhat aligned with shareholder value, need not be managed in any other dimension. The fact that we got the mathematics of finance coming in to the point where people were buying and selling, you know, basically probabilities of future events because you didn't know which mortgages would pay, how many people would refinance their mortgage prior to you know, this package being actually valued and so forth and so on. So you were just trading in probability functions, but everybody involved used the same statistics, and so you could reach a price because everybody was valuing these things in the same way. And since there was no basic loyalty to the investor, you were just selling to unknown investors because they were being distributed broadly, you lost your moorings. And so the industry started creating things that weren't all that good. Housing prices in the United States had never gone down, and therefore the assumption was they always went up, which is not a generally good idea to think. And people said there is no risk, et cetera, and we created a garbage industry. When it collapsed, obviously everybody was so intertwined that it collapsed together. All you had to do was to take one domino out of the group, and they were all totally intertwined. And had the government not stepped in, virtually every one of the major banks, probably not including J.P. Morgan Chase, because they were late to the party, but all the rest, Goldman would argue about this, but it would have been tough. Had AIG gone down, it would have been tough for them to survive. And the government stepped in and they saved them. So, did the industry become corrupt? Yes, in my mind, because when you talk about integrity, virtue, and moral principle, their behavior was strictly marketplace opportunistic. Was it criminal? Probably to some degree, but I don't think that was the essence of it. If you knowingly packaged bad assets and sold them, I think that's criminal. But I think there was a lot of innocent packaging of things that were questionable. You know, if the rating agencies knowingly misrated something, that's one thing. or did they simply not understand what they were doing, et cetera, et cetera. I don't think it was a deep criminal thing. I do think, though, it was a deeply corrupt thing, and I think the industry suffers from it still today. Unfortunately, and I don't understand why, there has been very little correction of the problem. By and large, if you're in the private sector, the worst thing you could do is go bankrupt. I mean, that sort of indicates that as a manager, you somehow failed. And if you do go bankrupt, it's not usual that you could say, well, the environment wasn't good, and therefore I went bankrupt. You know, by and large, you're supposed to be able to run companies in good environments and bad environments, and, you know, you're not supposed to say, well, I can only sail in good weather. And so all of these companies fundamentally went bankrupt. The management is pretty much still there. The boards are pretty much still there. Compensation practices have been slightly modulated, I would say slightly. In Europe, the governments are now getting engaged in trying to, by law, limit compensation. I don't think the laws are going to be all that useful or effective, but they do reflect society's values. And what society is saying to the industry is, we don't okay your practices in these arenas. And that, in the long term, will have a corrective effect. You cannot be sideways to the community's values forever. Ultimately, you need to have the approval of the community. And it'll affect the kind of people who are willing to come and work in the industry. So there'll be a feedback loop. But it did surprise me quite amazingly. So my view is the beginning of the problem was this shareholder value. The people who have big pools of money own a piece of that. Almost all the universities are very proud that they have private equities in their portfolio and so forth, and it's all part of the game. You know, you're willing to give money to people who are going to buy out managements, take companies private, and, you know, clean them up and then sell them back into the public market. That's what you do in private capital. There's nothing fundamentally wrong with that, but like everything else in life, it can be carried to extremes. And the compensation continues to be out of line with most of the rest of the economy and of the world, and it doesn't make a lot of sense. There's nothing that banks do that would justify having the top 1/10 of 1% of the capable people working in them. In other words, it's a pretty straightforward pedestrian business. Admittedly, if you insist on dealing with sophisticated you know, probabilities, you're going to have to hire some people who have been trained. But there's nothing magic about it. But what has happened is there's been this great sort of mystique, and people have been able to convince their bosses that they're individual practitioners who are worth these very large sums of money. And that is out of whack with what most of the rest of society feels, and you're beginning to see that. That's my story. How does an industry become corrupt? It becomes corrupt when you get forces at work that basically change how it operates, what it thinks is okay. You know, being willing to pay people more than you think they need to be paid, but you're okay because it lines up with shareholder value, probably is the beginning of a long, slippery slope. To be willing to sell people to investors, sell things to investors that you don't know, and therefore begin to lose interest in just what you are selling. Probably that's the beginning of a slippery slope as well. And, you know, we did it in spades. I mean, I estimate that we needed about $700 billion of more capital in the Wall Street community in order to cover the risks that actually were undertaken as opposed to the capital that they did have. So we would have needed another $700 billion in the capital structure of the financial institutions, at which point in time the stockholders wouldn't have been very happy with shareholder value, because if they had had to cough up another $700 billion in the capital structure, then the return on their capital would have been quite modest, and they wouldn't have been very happy with that. So the whole thing is interconnected in that sense. But it's a good, that's why I titled the speech Shareholder Value and Values, because what happened is shareholder value became the sole value, and values other than shareholder value got marginalized, and to some degree continue to be marginalized within the industry. And it is hard to reduce your standard of living. I mean, people don't often, $10 million a year may seem like a lot of money, but if you get used to having it, having 5 is a change. And it isn't like going from 0 to 5 where you feel very wealthy. If you go from 10 to 5, you feel very poor. And that just is the way life is, and so you can't be surprised that there's resistance in the industry to this kind of thing. But it was the shareholder value thing, and then this mathematics of finance, which created a marketplace that became quite disconnected from either the buyers on the one side or the creators on the other side, and it just didn't produce the right kind of outcomes to society. The final point I'd make, and we could open up for questions, is did it accomplish what we wanted? The 90s were a period of exceptional returns. And so if you think that during the 90s, as this shareholder value mantra was starting, did companies become more efficiently? Did their stockholders do well? The answer is yes. There's no question that during the 90s, investment returns were outstanding, and people could well say that, this shot in the arm, if you will, of managers. And by the way, managers responded. I looked during the 08 slowdown. I took the S&P 500, I took the financials out and was left with the others. I looked at 10 quarters of revenue and expense, and they just matched. The managements were quick to get rid of expense as their revenues dropped. They did not give up any margin. And if you look at prior periods, you will normally see that businesses lose margin during the downturn because they don't get the expenses out quickly enough, and they lag, and therefore they lose profitability and margin. So the managers have gotten quite adept. If revenues go down, they get the costs out very quickly, and the stockholders do well because you maintain the margins. So there's no question about it. During the last 10 years, there's a very different story. We had the dot-com bubble, which was an excess of some sort, and then we followed in 08 with the meltdown, with which we're still sort of recovering. And look at the return on Harvard's endowment from the year 2000 to today, and it probably is not outstanding. Because you had those two, you had the break in 2000, you had the break in 2008. So your returns have been quite modest over this last 10 or 15 year period. And of course, if you look at 5 years, they might even be negative. So have we produced better returns for these great pools of capital? It's going to depend over what time period you look. Certainly in the 90s we did. Was it a function of this revolution? Maybe it was certainly an important contributor. Has it kept going? The answer is no, it hasn't. Is it the right way to go going forward? I've always said, look, proportion and balance. There's room for shareholder value, but there's room for other things as well. And going crazy just and paying somebody $10 million that would be happy to work for $150,000 just because it's aligned with shareholder value does not intuitively make sense to me. And yet we got into a mode where those kind of things did in fact happen. So why don't I stop, and I'd be happy to change the conversation any way you guys would like. Yes, here.
So you need to press the button and hold it down when you're speaking.
Thank you. Hi, I'm Max Baserman from the Harvard Business School, and I teach negotiations. And I have a negotiation question that I have no idea what the answer to is. In 2008, it seems like the U.S. government invested in the auto firms and made a good investment both for society as well as for taxpayers. We also saved the banks, and it seems like we didn't get the upside potential. Can you provide some insight as part of the story about when the banks were about to go under, as you suggest, why we didn't get more of the upside potential in return for saving them?
I think the people who were negotiating on the other side were not looking at an upside. They were just trying to save the banks. And not because they cared about the banks, but they were worried about what it was going to do to the economy. And so I think they didn't pay much attention to it. You know, if you were a cynic, you could argue they all came from the industry. And, you know, therefore were not psychologically likely to bargain, you know, in that sense. But I think that really they just didn't focus on it. I'm not sure, by the way, that you could be quite so comfortable with the auto industry. It is true the government made some money, but they wiped out everybody from whom the auto industry had bought. When you go through borrowed, when you go through bankruptcy, all the creditors disappear. And it is true the workers have their jobs. It's true the government made money. I paid no attention, but there must have been a lot of people who lost money in that transaction too. And I don't know if it was equal to or greater than the profits that the government made. But if you want to say what did it do economically, you should look at what were the losses to the creditors as well as the gain to the government and in the negotiation. But you know, there is a general feeling that the Secretary of Treasury, both in the Bush administration and in the first Obama administration, were deeply of the culture that was coming a cropper, and they therefore never were in a bargaining mode. They didn't view their job in that fashion, and therefore they did not get the upside that you're talking to. Yes.
Hi, thank you. Do you think corporations should have an imposed responsibility for society to do good in society, and how could that be imposed? How could we move towards that to try to remedy this situation?
I don't think it could be imposed, but society can assert itself in viewing certain kind of behaviors as being unacceptable. And there's tons of ways through shareholder resolutions. I do think I would give shareholders more of a say in compensation. They're gradually getting a say, but it's quite gradual. So I would want I believe in transparency, so I would insist that, compensation be quite visible. And I also believe you should give stockholders a good shot at expressing themselves, and over time it'll get balanced. I don't know, imposing obligations is difficult. I mean, look at the Fed trying to balance, economic growth, unemployment, and interest rates and inflation. I mean, they have a mandate that's almost impossible. You got to be on one side of it or the other. So I wouldn't look to impose, but I do believe that transparency and making things public goes a long way to cleaning up things. You can't get way out of whack with the public. Yes, ma'am.
questions may seem a little different than others. I'm curious about the relationship between paying someone what they're worth, their job, by deciding who else you could get who would take the job for the same price, and as opposed to giving people who work a share of the profits that they produce. Now, in this context, your view that the former is the better policy may strike us as appealing. But labor unions for a long time have tried to get stock options for their employees. They think of it as some sort of response to the idea that their workers are not getting the profits that they have produced, labor theory of value or whatever. And so it seems that the progressive movement has for a long time been trying to get wages connected with the profits that are produced by the workers rather than simply competition among workers for the lowest salary. So if you take that broader perspective on this movement, right, it doesn't seem altogether outlandish. Maybe the problem is not with that principle, namely sharing the profits, but what you get the profits from. So maybe there should be higher wages connected with consumer value or customer value, so that you don't start selling junk, as you put it, garbage, I think was the word you used. It's all technical terms, of course, in order to get higher salaries, because somebody else's higher salary depends on the quality of the product that's being sold. So I'm just wondering whether the principle that you've identified with as the fault is really at fault, or there's something else, right, that doesn't identify profit sharing as the fault, but what you share profits from. I mean, get customer value back in there as raising salaries. Sorry for going on. Thank you.
No, what you're saying makes a lot of sense. First of all, I think most people would agree that allowing people to share in profits that they contribute to is fine, and lots of us, including in the bank, have programs that are designed to make available to everybody. In our case, we did have stock option and stock purchase plans for all employees, and we also had savings plans that paid where we paid a portion of the bank's profits into the savings accounts so that people would get a return on their savings that was directly proportional to how the bank's profits were. There's no objection to that. What happened here is you got a lot of ego where people wanted to be paid a lot of money, not because they felt they'd contributed anything, but it was very important to have the bragging rights to say, I've been paid a lot of money. And so you got a lot of negotiating going on of people who made no effort to justify any contribution that they might have made, but instead simply said, if you want me around, you're going to pay me this, and if you don't, I'm leaving. And for whatever reason, on average within the industry, they paid. And they developed formulas that simply, the formula in the investment banks was that they paid out 50% of the pre-tax profits into bonus pools. Then you could argue how to divide those bonus pools amongst the people. And that's what they did, and they felt that that was a working business model. But you better be careful. They were paying on book profits, not profits realized. All of this talk going on now about clawbacks says, hey, if we've paid you a bonus, but then when it turns out that the activity you were generating didn't produce profits, but in fact produces losses, we want the ability to go back and get those back. So if you want to tie performance, first of all, it's awfully difficult to identify performance. If you take a trader and you put them in Citibank, and you take that trader, same person, and you put them in Joe Schmo Bank, their performance could be wildly different, because the guy in Citibank's going to have all of the phone calls and all the opportunities to do trading because, for example, we didn't do much trading when I was there, but we were very big in foreign exchange. No one in the world bought a significant sum of foreign exchange without getting a quote from us, because we were the big gorilla in the foreign exchange market and we had the deepest sort of activity. So they might have done the transactions elsewhere, but they sure called us. Not surprisingly, our foreign exchange traders did very well. But sometimes they'd quit and they'd go down the street with 3 friends to set up a small boutique, and they didn't do well at all. Same person, same trading skills, but they didn't get the flow. So how much of it is the sweatshirt and how much of it is your individual? It's very hard to look at a person and say, that person really made all of this money that we're booking. And then it's very difficult to make sure you have the money in hand. There's a big difference between realized profits and book profits. And so, but the general principle of paying people for what they produce makes sense, but you always got to remember that if there's a guy behind you who could produce almost the same for half the price, you're going to be tempted to hire him. So you can't avoid the fact. And what we tried to do was to bring up people from the bottom. We tried not to have star traders. And by the way, Goldman is extremely good at not having star traders, and because they want the team to do well and not to have an individual in a bargaining position where they can, extract funds from you. Yes.
So I'm Kim Purnell Gallagher. I'm a residential fellow at the Saffras Center. So the story so far has been about banks and like ratings agencies, but they're operating in an environment that's set by the banking regulators. And so I'm wondering, what was the effect of the shareholder value model on them? Like, did they buy into it, and how might that have affected their decisions leading up to the crisis?
I think they were swept away from it. The regulators are not an independent force. By and large, they're quite competent and they're very good. And if you get to know them, they're quite knowledgeable and able people. Unfortunately, I got to know them too well sometimes. But their view of the industry is derived from the industry. They don't have an independent source of wisdom. They spend all their time with bankers and with other regulators who spend their time with bankers. And so I noticed that it was highly unusual that a regulator would be at variance with the industry. When we got into all the trouble with Latin American debt, there were no regulators saying, why are you guys doing that? When all of these problems developed, they didn't do it. The only exception to that, in my experience, was the Bank of England. The Bank of England had an exceptionally well-trained professional staff. I'm not talking about the governor per se, who sometimes is a political person, sometimes is not. But their professional staff, and the Bank of England is willing to exercise judgment. In America, you got to go by rules. The Fed can't treat me differently than the guy down the street. In the Bank of England, they can. The Bank of England, they'll call you in and say, John, we want you to stop doing X. And you can't say, but Barclays is doing X. They don't care. They say, we don't think you should do X. And by and large, they have a reason. It's not cavalier. And if they tell you, you do it. They didn't spot this problem either. And the FSA, the Bank of England had lost its regulatory authority, and the FSA had it. They didn't pick it up either. But by and large, I think it's a mistake to assume that regulators are going to be wildly more, well-informed than the industry. Yeah, right behind.
Yeah, my name is Greg Fields. I'm a research fellow here as well. You were, in my mind, at ground zero with the merger of Citigroup and Travelers and the repeal of, the
Glass-Steagall.
Glass-Steagall. I'm just curious now, when you look back, I mean, would you have done it differently? Should it have been done differently?
By the way, Glass-Steagall was basically repealed. In other words, we walked through an open door. The political support for Glass-Steagall had evaporated, and no one felt that Glass-Steagall was an appropriate piece of legislation at the time. So we had little to do with the actual, we happened to be the first transaction, and therefore we're given credit for having ended Glass-Steagall, but it had ended. We just happened to be the first people to take advantage of it. Yeah, I'd do differently. I wouldn't do the merger, and I've said that publicly. It was a mistake. It wasn't a mistake on business grounds. It was a mistake on social grounds. And the organization was culturally extremely difficult to manage. It could have been managed, but you know, anytime you build a business that will only succeed if you have the three smartest guys in the world running it, it's not a great business, because on average you're not going to have that kind of talent. And so, you know, the real difficulty was Salomon Brothers within the total configuration. It wasn't Travelers Insurance, and it wasn't the brokerage business. It was Salomon, and Salomon had had a long history of trading difficulties. You know, they were a great firm, but they went bankrupt at least twice. And so the answer is I wouldn't have done the merger. And I do believe now that there is no upside to putting these two businesses together, and I think there's a big cultural downside. It is almost impossible to keep the traditional banking culture separated from a trading investment banking culture. It's just can't be done. And people are human. The two businesses are quite different, and you just, you know, it's just hard to do. Maybe if you had a total, you know, separation like the old Bell system that could have Bell Labs on one side and the operating companies on another side, they were able to balance multiple cultures successfully, but in a very, you know, diversified way. So I don't see any upside. I've been in the business. I cannot put my hand on any economies of scale or other benefits that come from working together, and therefore I don't see why we should do it. So I'm very much on the side of Mr. Volcker when he says, why don't we just split it aside? And anybody who says you can't do it is just lying. They can do it, they just don't want to do it, which is a different matter. Yeah, back.
Yeah, this is working. Hi, so I'm a student at the College of Economics and Statistics. You recently talked about the idea of a green mail, in which investors who see a company that's sluggish, they move in, they buy a certain percentage of the stock, and then they pressure upper management to change via a proxy fight or lawsuits. This has been pretty prevalent in the news lately with, I'm thinking specifically with a guy named Carl Icahn, who's been known for doing this and profiting a whole lot by doing this. What is your opinion on green mail now and in the future, and how will this affect the value systems that you talked about? Not just shareholder value, but values in general.
Well, it's, you know, there's a role to be played. There's no question that bureaucracies become lethargic. You know, when I first got into the business, management ran the business. The stockholders were sleepy. You didn't pay a lot of attention to them, and so you ran the business according to the values that you had. That wasn't necessarily right either. Some businesses did very well, but many businesses, you know, became very slow and so forth and so on. Obviously, the idea of anything that will cause businesses to become more efficient and more effective is worthwhile. And green mail, when it first started, was effective in taking a lot of companies that had become sort of conglomerates of meaningless things and forcing them to split up and separate and to create more effective units in various different businesses. And that served us well, and I think you'll find if you look over this period of time, there have been some good productivity gains in the economy. But like everything else, when you go from let's have the management run a good business to we don't care what you pay yourself, you begin to breed in excesses that come back and destroy some of these values.
Right,
And-
but I'm sorry, but don't guys like Carl Icahn really force the management to change their ways and to really, he talks about cutting down pay by a great factor for
Generally, it's pay
executives.
for the general worker and not for the management. The managers generally do very well. And they're incentivized to do them. They give them a lot of the stock or what have you, and they get them aligned with whatever Mr. Icon's trying to do. And look, I'm not going to make a categorical statement that this is bad and that's right. I'll just say all of this is bad and all of that isn't right. You got to have balance, proportion, and balance. And we got carried away. And if you doubt it, just look at the behavior that became commonplace within what had been a very traditional, responsible sort of industry, where you all of a sudden basically were playing a function of packaging products and selling them to people without the slightest sense of responsibility on either side of the transaction. And, that is aberrant behavior, I think, by any definition. But that doesn't mean that every management buyout is wrong. Yes, Rebecca.
So my name is Rebecca Henderson. I'm on the faculty at the Harvard Business School. John, you've really focused on compensation as a key issue in what went wrong. A number of observers has focused on timescales and the fact that the modern markets seem to be very short-term oriented. Do you think that played a role in the debacle? Is it important now?
Well, certainly at the managerial level it is. If all you care about are next quarter's earnings, you run the company obviously very differently than if you're worried about a more distant target. So timescales makes a difference. Compensation became annual, as you know, and bonus times were a big deal. And that just worked its way into the environment. I mean, I think shareholder value has a short-term quality. One problem, of course, is you don't have long-term shareholders. One problem I had at Citi, Fidelity used to have a big position in the company from time to time. And I'd tell them, I'd say, how the heck can I pay attention to you? You're here for 30 days, then you sell out, and then you're here for 15 days, and you sell out, and you're my shareholders, and I'm supposed to run the company. You don't know what they want. So not having long-term shareholders is another time element. By and large, and I haven't looked recently, but 100% of your shares would turn over each year. Now, that doesn't mean there was no one who stayed there, but, there were enough people who were short-termers so that the total volume, and so that could play, yeah.
If I could have a short follow-up question. What do you think about some of the proposals that have been advanced to slow capital down, to, for example, restrict voting rights to long-term shareholders, to put in place dividend policies such that you don't get the dividend until you've held the stock for a while? Is that a good idea?
I've always thought it was a good idea, but I've never figured it could be done because, it's like certificates of deposit. Certificates of deposit came into existence because somebody'd have a deposit at the bank and they'd make a lot of money because we were paying, more for a 6-month deposit than for a 3-month deposit and so forth and so on. And so a secondary market developed where, they sold their deposit. We thought we had the same depositor, but it had been sold. And so we were paying 6 months rates, even though you could buy and sell certificates of deposit every day. And people will do that with stock. I mean, if you have stock, I've always said I'd love to pay long-term shareholders better dividends and things like that. But I've never figured out how you could do it because, they'll buy the stuff and then there'll be a secondary market and, away you go. Yeah, and back.
Hey, sir, good evening. First of all, thank you very much. Julian Geiser, I'm not affiliated at all with Harvard. I wish I was. I'm just lucky enough to live close enough to come to these. But so my question for you is that, I'm honestly pissed off and angry about the way that all this business was conducted, maybe potentially for the past 15 to 20 years. I'm active duty military, and I know that an officer and a manager are responsible for the culture of their community or the command and of the industry. I think you maybe gave them a little too much. I feel as though what they did was criminal. I think there was a criminal negligence on the part of the leadership at the top, and I guess I wonder, if the government is unwilling to hold them accountable, which is what it kind of seems has happened, how do you suggest the public holds them accountable? I was here about 2 or 3 weeks ago. We were talking about public policy and how the rich essentially control the movement of public policy. How does the public affect it? Occupy Wall Street didn't seem very productive. What would you suggest?
Well, look, I do agree that there was some negligence, particularly at the most senior level. It is true that you can't expect directors to understand derivatives, but they certainly know leverage. You could ask how much debt and how much capital you have. Any director could do that. And they had wildly too much leverage, and directors should have known that and stopped it, and they didn't. So I agree with you. That's why I say the duty of care, which is one of the duties directors are supposed to have, means you're supposed to pay attention. So I agree with you, there was some negligence. I tried to say this isn't all criminal. Enron was criminal. This was just horrible. And but on the other hand, the only way that this is going to be dealt with is if the public cares. If the public cares, the politicians will, listen eventually. If the public doesn't care, the politicians won't. The lobbying power of big companies is large, as true also, I guess, of big unions. So it's not just large organizations have a lot of lobbying power. And I was frankly disappointed that the Obama administration took somebody from Wall Street, made him Secretary of the Treasury, and, there was no possibility that he was going to deal with this thing in a tough way. But I assume the president knew what he was doing and why he was doing it. And so the only sense I have is the people don't want to hold the industry accountable. Now, if you read the history of the Depression, it wasn't until 4 or 5 and 6 years later that you got a legislative response. I don't know the date of the Pecora hearings in the House, but it was quite a bit after the Depression. And so you could have a slow response time. In other words, this could at some point be dealt with. But I was quite surprised, given the severity of what happened and the clarity of what some of the mistakes were, that CEOs and boards continue basically as they were. Yeah.
So in understanding derivatives, of course, it's very hard for people to figure out a lot that was going on, even members of the board. I get that. About a bunch of hard stuff here. But there's a bunch of stuff that seems so easy and obvious. So for example, as you said, of rating agencies, all the inducements were running in the wrong direction. That must have been obvious to everybody at the time it was happening. And I guess so one part of my question is, why was it so hard to deal or even think about or raise a policy question about what seems to be an obvious problem? And then the second part of the question is, you haven't talked a lot about what's being done now in response. So we had Dodd-Frank, and we had endless hearings to figure out what those regulations should eventually look like, how will the Volcker rule be implemented or not. And then just today, Democratic congressman, former Goldman Sachs partner, has introduced a bill to completely deregulate all of the derivatives once again, because the claim is that the Volcker rule and Dodd-Frank is too complicated. We just have to get back to the simple old good days of derivatives being on. And so again, it seems like such an easy, obvious thing that we can't seem to get right. So what is it that explains not the inability to deal with the hard problems, but the inability to deal with what should be easy problems?
This is political process, and I am not a political scientist, nor do I have any understanding of how Washington works. I observe what you do, but take accountants. Accountants are paid by the people whose books they look at. That creates conflicts. and we've seen it. It's rare, but we've seen it, and even that, it's obvious that the people who should pay the accountants are the people who buy the securities that these firms issue, because it is they who would want to know that the accounting is straight and the securities are as represented. So we have all sorts of strange things. There's an unwillingness in Washington to confront these things unless the public really gets excited. And that's political science. And why don't we have gun legislation? Same thing. The political process doesn't deal with these things unless the public really cares, and you may be an exception there, but you're the only one who seems to really be unhappy about what happened. Yeah.
Yeah, hello, my name's Justin O'Brien. I'm from the University of New South Wales. I find your argument very persuasive, but I suppose the real question about whether or not the public cares, sometimes what happens with regulation, all battles are fought in implementation, it becomes all very technical, and the public get lost in the detail. But I think something has just happened over the course of the last year which potentially could change that fundamentally, and that's the investigation into LIBOR. Lanny Brauer, who's just stepped down from the Department of Justice, has claimed that this is going to be the biggest white-collar crime in history. We've already seen multiple settlements, at this stage only against European and British banks, but American banks, including Citi, are involved in the LIBOR setting process. And of course, LIBOR could only have been manipulated if there was collusion. So this is not just institutional corruption within an individual bank, but across an industry. I was just wondering what your thoughts were
But this
about
gets
that.
back to values. By the way, Adam Smith said that if you see two businessmen talking, they're setting prices. And so it's not new. Collusion seems to have been there. I was unaware of it. LIBOR certainly was around when I was in the bank. I have no knowledge of any mispricing, but I think they, for whatever reason, but it gets back to this value issue and cultural issue. There are some things that became tolerated in this environment that had not been tolerated before. I mean, you simply didn't do some things, but all of a sudden it was okay if somehow you earned more money. And, you know, I used to say to people when we talked about compensation, you can't buy me with earnings. In other words, I had people who had divisions whose earnings went up very nicely, but I didn't think the manager had much to do with him, nor was he somebody that I felt highly about, and so I didn't pay him a lot of money. And they'd say, but my earnings went up. And I'd say, you can't buy me with earnings. It's other sides to this. But somehow, this idea of making money by cheating a little, and you know, no one could see 1/10 of 1%, but that's what you're dealing with when you're set LIBOR. But you know, Salomon Brothers had the same problem when they tried to corner the market in U.S. government bonds. They were putting in false bids so as to get an allotment of a larger share. And, you know, these kind of little things, the only way you get them is to have an ethic that says, we don't do that. And that has to come from the ethic and the culture. And it's hard to do. But that's what got eroded through this focus on, hey, if you earn more money, everything must be fine. Yes.
Excuse me. The Europeans seem to be going at this by saying what we need to do is limit the incentive compensation, and we're going to limit it to 100% of salary.
Yeah.
Now, does that sound positive?
Well, it reflects their values, and if I were running a bank in Europe, I wouldn't pay much attention to the legislation, but I'd try to say, hey, what's behind it? What are the values? You could get around this. It is so easy to have contracts that pay out sums of money. It could be your salary. Your salary is going to be X. But if things go really very well, you're going to get more than that. I mean, the Financial Times wrote a very nice letter in the back page of how you could give somebody a salary of $10 million, but they were going to only get 3 unless something happened. But the 7 wasn't a bonus. It was a clawback on the salary. And, the point is, it's going to be very hard to write legislation that will cause you not to be able to pay people well. For a long time, the reason everybody in England had a car and a driver was taxes were such that you could pay people by providing cars and drivers and cooks and so forth and so on, but don't pay them any cash because those things weren't being taxed. And so everybody in England had a car and a driver and so forth and so on. So compensation you can't legislate, but what you can do is you could have societal attitudes about compensation that will cause companies to pay attention. And what they're talking about in Europe will force the banks to pay some attention to that. I don't think you're going to be able to legislate it so they can't pay somebody if they choose to. Yeah.
He's the only one angry. I'm angry. I've heard Larry Lessig be angry about these issues. I think lots of people in the room are angry. And it's not just what happened in 2008, but I think a lot of people are angry about the fact that it's not criminal behavior because they didn't violate laws, but they also bought the laws that they then didn't violate.
Mm-hmm. Yeah.
And so whether you go with rating agencies who basically have a race to the bottom to please the clients, or auditing firms who have a race to the bottom to please the clients, we're not fixing the systems, and it's not the Washington politicians aren't making these decisions in a vacuum, but rather there's lots of money coming in to prevent them to fix the system.
Absolutely. No, I agree. Look, you could change the system in the right direction. Fix is a big word, but you could move it in the right direction very simply. Capital, leverage, counterparty risk. If you simply put out rules on those 3 things, you could reshape the industry. But the power of the lobbyist groups, and it is very much in their interest to have legislation that runs 10,000 pages and can't be understood by anybody, et cetera, et cetera. And so all of that is symptomatic of the problem. And the fact of the matter is that there isn't political will for whatever reason. Susan.
Susan Silby, MIT faculty. So, John, you put great emphasis on the role of values in driving what happens as individual incentives, as organizational forces. And your values have been very clear. You've made them, you've articulated them repeatedly. So my concern is, where do these values come from? You've mentioned repeatedly that we have problems with societal attitudes, with preferences. I want to offer a hypothesis and ask you to respond. In the last 50 or 60 years, the popular discourse and the academic discourse has offered a set of values that have driven us in this way. And that value is efficiency, and the market as the mechanism for allocating preferences and determining what is good and what is not good, because we don't have any other way of doing it. And so I'm wondering if you have some advice to offer as to how we might shift the value from efficiency measured by market outcomes to some other forms of value that are sometimes at play in Europe, which has a different history, like solidarity, loyalty, quality, longer time frames rather than shorter time frames. One of the historical explanations for our supposed uniqueness is we're a new country, they're old, or China, the story, supposedly, I think one of our foreign dignitaries asked Zhou Enlai what was the result of the French Revolution. His answer was too soon to tell.
Too soon to tell.
200 years later, too soon to tell. Well, so is our problem? How do we change the values if we believe that efficiency is the achievement of the technological society?
Well, how to do it, I don't know, but I would agree with you that it is all about values. I start out saying when I joined the industry, the value was customer. And the value was we don't do anything, we help our customers do things. We always said that the way to evaluate a bank was to look at its customers, not its balance sheet. If you had good customers, the bank would be doing well, and if you didn't, the bank probably wasn't. But it was very much, we brought some values to the job, and in the job they were validated. In other words, you cared about the community. That was a value. And you may have seen that just recently the now CEO of Citi has come out with a, quote, balanced scorecard. Now, a balanced scorecard is a mechanism, and we used that kind of thing, to try to say to people that there is no one single value. We were lucky because we were an international company, and we had a substantial portion of our business overseas. And you wouldn't get permission to be in the country unless the country thought that you contributed something. And so you were constantly conscious of the fact that you had to earn the right to be there by being a part of the society and so forth and so on. So we became very conscious of that as a sort of value proposition. The shareholder value thing trumped the rest. Maybe it's efficiency, maybe that's what you're saying, but the way I experienced it was this mantra that all of a sudden, anything I want to do, they said, well, shareholder value. I mean, when I was in the bank, we didn't know the price of the stock more than once a month, maybe. We certainly had no tickers around. People weren't looking at it. No one cared. Nowadays, you go into any financial institution and you get the thing going by 7 by 24. Those are values. We employee values. If you have 25 century clubs where you celebrate employees who have been there for a quarter of a century, which we used to have, and those were values that we celebrated and the community celebrated, and you couldn't get away if you didn't sort of share in them. A lot of that's been eroded and replaced by this. You could call it efficiency. They'll call it earnings per share. But that's, and mind you, don't forget the investors. These great pools of money do have to worry about earning a return, and the question is how does that play into the equation? Harvard cares an awful lot about how their funds do, and would they be willing to earn 2 or 3% less per year by investing in companies whose values they more agree with? No. And so there's this juxtaposition. Bob Darnton behind you, I'm sorry.
I'm Bob Darnton from Harvard. I'd like to follow up on the previous question because that haunted me throughout your talk, John. And I've always thought you're an excellent historian. You gave us a wonderful historical account of how things happened the way they happened. But at the end, I felt the argument got weak because you invoked values, attitudes, the public, all sorts of forces that do exist, but it's very difficult to see how they exist. Value systems are complicated. There are lots of competing values. The public gets measured by professionals, but it doesn't really speak, and there is no single public. There are elections, and we know how representative they are of value systems, etc. So what worries me is not the validity of the analysis, but the force of the conclusion, because I simply don't see how somehow this public is going to somehow transform its values and adopt different attitudes that will fix things.
Well, I share your frustration. The way to do it is by regulations that would change the structure of the industry. But and the reason I related the story the way I sensed it was we do have great pools of capital. You know, in the household sector, net worth of households are 5 times annual disposable income. In a developing country, it's twice. I mean, we've just accumulated these big savings in 401k plans and so forth and so on. And so there's a whole world out there of investors who are looking for return, and their only value is return. They don't care what product you make or how you made the money, et cetera, et cetera. Some of these computer programs don't even know what they own. So we have this real thing, and you can't ignore it. The return to these large pools of capital are fundamentally important to society. You know, there are insurance reserves and so forth and so on. So on the one hand, you have this drive for performance, efficiency, if you want. And then you have these institutions in which they invest who we want to operate in a more balanced fashion. That's a difficult architectural challenge to put together. And I do think you can write rules that would have the effect of restructuring the industry in ways that would make it less susceptible to these kind of problems. But I think you're talking about the structure of the industry. And then you get into this problem that you can't get anything like that done because the powers that be in Washington aren't going to do it. The Europeans are trying, not with great success, with this banking directive to try to, you know, write some rules for this sector. And we're going to have to do that to get the values. I don't know any other way.